Welcome back to another episode of Retired Right. I am Ryan Wyatt, and today I'm joined by my compadres on the investment committee, Ron Wyatt and Nick Lewandowski. Gentlemen, how are we today?
Doing very well. Thanks for having us.
You guys getting excited for the holidays?
Very excited.
Looking forward to it.
Yeah.
For the topic today, what I wanted to focus on was bonds, and we're going to break it down into I'd say like three main segments. The first is just going to be a high-level overview of what bonds are, why somebody would invest in them. The second is going to be talking about some of the risks associated with bond funds. And then what I want to do towards the end of the episode is bring it to more of like a firm level and talk about how we construct our bond portfolios, and then maybe just some of the beliefs that we have given the context we provided earlier in the episode. So with that said, let's just, whoever wants to take it, let's just start very high level. What are bonds and why would people invest in them?
Yeah, I can go ahead and jump into the what, and maybe Ron can talk about the role in a portfolio that an investor would typically have. So a bond is pretty straightforward. I mean, you're really just making a loan to a company, or in some cases, a government entity. And so, it would be cumbersome for every individual person to negotiate a customized loan. So a bond is a prepackaged set of terms, basically. Mm-hmm. So you have what's called the principal, which is the amount that you loan or purchase the bond for. And then the bond has what's called a maturity, which is a date in the future at which the principal is paid back to you.
Got it.
And in return for lending the money, you are promised a return in the form of interest payments, basically. These interest payments can take a couple different forms depending on the type of bond, but typically, what people would associate with a bond would be an interest rate that pays, semi-annually a couple of interest payments.
Okay.
There can be a couple other types, like some bonds that we own and are out there in the marketplace are floating rate, and the interest rates actually adjust depending on different things that are going on. But just a high level, that's good. Now, a bond fund, which is what we actually own for our end clients, will own a bunch of different bonds according to a particular strategy, and so it's a whole bunch of bonds put together basically into a portfolio.
Got it. Okay.
One thing I wanted to say too is that for clients that have larger accounts that prefer to have individual bonds, we can do that as well. The accounts tend to, the size tends to have to be pretty decent size to make it worthwhile.
Okay. So you're talking a lot about interest payments. So is that one of the primary reasons people are investing in bond? Is that income component?
Yeah, I think, Ron, if you want to take where we see bonds fitting in client portfolios or why people want to own them.
It's simple. Two reasons, really. One is bonds pay interest that the yield tends to be higher than stocks. So for people who oftentimes are retired and want to earn a decent income, bonds are great for that. The second reason is that it helps reduce the risk of the stock portfolio. So a portfolio that has 100% stocks is a lot more volatile than a portfolio that's balanced with maybe half stocks and bonds, right?
Okay.
So as a person gets closer to retirement or in retirement, decreasing risk is really important when they're taking withdrawals, which in one of our episodes we'll cover in much more detail.
Okay. So I think that's a pretty good segue. And I mentioned one of the second topic that I wanted to talk about was actual risks associated with bonds. And Ron, what I think you're kind of alluding to is that what's called credit risk, or how it acts as a cushion against the stock portfolio. So could you just further expand and tie credit risk into the conversation?
Sure. Credit risk is, like Nick said, bonds are issued and they have certain terms, right? An interest rate, when the principal is going to be returned. Credit risk is the risk that the company cannot meet its obligations.
Got it.
Right? So the obligations, the semi-annual interest payments, and return your principal. And how we judge that is there's agencies that rate bonds. And so triple B to triple A is considered investment grade. That means there's a high degree of likelihood that the issuer can meet its obligation.
Got it.
Below triple B is considered high yield or junk.
Got it.
People call it junk bonds. And that means that the lower in the scale you go, the more difficult or the less likely it is that the company or companies can meet their obligations.
So that's kind of two opposite end of the spectrum there. So at the most kind of credit-worthy side of the spectrum, can you just give like what a typical issuer might look like? Is that corporations always? Is it U.S. government?
The treasuries are AAA. They're considered the safest in the world. Hopefully it stays that way.
So those are U.S. government issued bonds.
Treasury bonds, right.
Got it.
And then there are a few corporations, not many, maybe around 5 or so, that are AAA rated as well.
Okay. And then the opposite end of the spectrum, kind of in the junk bond realm, can you give an example of what an issuer might look like there?
Yeah, an issuer, I mean, think of it as like an individual, right? So if an individual has X amount of income coming in and they have obligations for a mortgage, for their car, they have a lot of credit card debt, it's going to be hard for them to meet all those obligations, right? So the more leveraged you are the more debt you have compared to the level of income that an individual or a company is generating is really how you determine the credit worthiness of an entity.
Got it. So we already talked about, U.S. Treasury bonds being kind of on the other end of the spectrum in terms of credit worthiness, very credit worthy. You wouldn't see those necessarily in the junk bond category. Would it be more of like a corporate issuer?
Yes.
Got it. Okay. And then anything else besides corporate can you see show up in that category?
Municipal bonds.
Okay. So some municipal bonds.
And some there's emerging market debt that some of it's considered high yield, but that's not
Okay. And then why don't we talk about, so that's credit risk. So I guess the one follow-up question I have is, so just because we've been talking about two basically completely different bonds, the very credit-worthy treasury bonds, the junk bonds, the higher risk bonds, then you said earlier they can act as a cushion against stock market performance. So if the stock market's doing poor, are those two different types of bonds, really well-rated bonds and junk bonds, are they going to function the same way?
No, not at all. For example, during the global financial crisis from 2007 to 2009, Treasury bonds did very well. The economy was slowing, interest rates were going down, inflation was going down, interest rates were going down, so Treasuries went up in value. They provided a good offset to the stock market. On the other hand, high-yield bonds during that period of time, if the stock market was down around 60%, high-yield bonds might have been down around 40%.
Right.
So there was a little less risk than the stock market, but they're still very correlated to stocks, so they don't diversify a portfolio as much.
Sure. And if you think about that, I mean, intuitively it makes sense. Like maybe when you're younger, in your 30s, 40s, and you're kind of in that accumulation phase, a lot of our clients are 50 plus. When you're younger, you can afford to take on that risk, so you don't care as much about the diversification, or you don't care about having different asset classes that are going to function in different ways when the market's under a lot of pressure. But once you get closer to retirement or in retirement, now you're actually drawing down on your portfolio, you want to have the diversified portfolio where it's like, hey, if the stock market's doing poor, my bond fund might actually be giving positive returns. It's cutting the loss off at the knees, essentially.
You want to try to get decent returns that are consistent.
Right, and it's not a roller coaster ride, it's a smoother ride. That makes sense. So,
and I think one of the things that people sometimes end up with too much risk, or we would say it's too much risk in that bond piece, because it's very easy to look at the higher yields of that low-rated debt and just become enamored of like, well, I'm earning 8%,
right.
I'm earning 9%. But the reality is that there's a ton of risk associated with that yield. So that's something that I think in general, the audience of the podcast can never hear too much, right? Is that, if you're earning that high of a yield, you're earning it for a reason, generally.
Right. Right. If you see a yield of 15 or 20%, you probably want to run away.
Perfect. So then there's a second risk that I wanted to talk about, which is interest rate risk. So whoever wants to tackle that one, please feel free.
Yeah, I'll take it. So interest rate risk is really tied in a lot of ways to inflation as well. Interest rates and inflation have a very strong relationship. So if we start about why inflation is important to bond owners, the reason is basically that if you look at cash-like investments over time, Ron, you'd say they probably kept pace with inflation, like since the beginning of time?
Historically, cash and inflation have been about the same, the returns.
It's riskier bonds, provided you don't get beat up too much on credit risk over time with losses, maybe earn a relatively small premium over inflation over the long term. But so ultimately, it's really, really important when you invest in fixed income to kind of make sure that you're earning enough in terms of the interest component, that you're not losing too much purchasing power over time. And so what ends up happening is investors in bonds are rightly very concerned with the level of interest rates relative to the bonds that they own. Now, we have a graphic, I think, of like a seesaw, and this seesaw illustrates the important thing here, which is that bond prices and interest rates move opposite one another.
Got it.
When interest rates go up, bond prices that are in the marketplace go down, and vice versa.
Got it.
So the mechanism for why that is, and this is going to be a bit of an oversimplification. I'm going to steal Ron's thunder a little bit. I used to explain this a little bit differently. But
And then you heard him say it so many times. Now it's just...
Hey, I'm the young pup. He's the experienced guy. No, but we basically say the same thing. Just I like some of what he says here. So if you own a bond at 3%, you're happy with your 3% interest, you're okay with it. Then all of a sudden rates go up to 6%, and you can go out and buy new bonds that are at 6%. Well, why would you keep your 3%, right? You want the 6. The 6 is better for all the reasons that we've discussed. So you're going to sell your 3% bond in the marketplace, but someone's got to buy it.
Right.
And they are going to want compensation for the fact that they're buying a bond that yields, less than what they could get by buying that bond. So you sell it at a discount, basically.
Right.
And that mechanism forces those prices down. Eventually what happens is, for those existing bonds that were issued at 3%, they trade to where their yield based on the marketplace price that they trade at is equivalent to the interest rate environment, and the seesaw kind of levels out.
Okay, so I like how you said levels out. So basically what's happening is it's kind of leveling out the playing field between previously issued bonds and newly issued bonds, kind of making them 6 in one hand, half dozen in the other.
That's correct.
And then I wanted to hit on something you said at the very beginning, just to kind of bring this interest rate risk point full circle. You said that inflation and interest rates have a very strong relationship. Can you just define that a little bit further and explain why? I think when you say strong, you probably meant like a positive relationship.
Yeah, positively correlated.
Got it. So rates go up, inflation goes up?
100%.
Got it.
Exactly.
Can you just explain why?
Yeah, so the reason for that, in my mind, and Ron, if you have additional thoughts, feel free to jump in. But in my mind, the simplest way of explaining that at a high level is that in the modern financial world, we have central banks in countries that are responsible for determining interest rate policy. And what central banks want to see is a little bit of inflation, because inflation and economic growth are also very positively correlated. So they want growth and they want some inflation because it's a byproduct of growth. What they don't want to see is really high levels of inflation relative to what's happening with underlying economic growth, because that basically just means that the population's purchasing power is being eroded. And I mean, I'm not trying to be political with this comment, but you just look at elections around the world in the last few years since this COVID inflation, it's been very bad for incumbents.
Right.
People in the population do not like high inflation. So what central banks do, their tool for this is actually really simple. When inflation is higher than they want to see it, they raise interest rates. And the idea of that is super straightforward. It's just we're going to make it more expensive to borrow money. If debt is out there that is at floating rate that adjusts up, it's more expensive to pay.
To buy a car, to buy a home,
all these things. And all that trickle down effect basically causes less economic activity. It causes growth to come down. It causes less money to circulate in the economy. And then as inflation comes down, the central bank says, okay, mission accomplished. Now we can cut rates back.
Oh yeah, and I mean you can feel that. I mean, think about COVID, low interest rate environment to now. I mean, I was personally in the market for a home during COVID, sold that one. Looking again, it's like night and day difference. You can feel it.
Yep. Let me add something what Nick was saying. So, why would people buy bonds instead of just leaving their money in cash? And the answer to that is that bonds have paid, investment grade bonds, right? We're not talking about high yield, but investment grade bonds have probably since the 1920s till now paid 2.5% more than cash. So there is a reason to have some money in bonds and not keep it all in cash.
Got it.
The other thing too is, Nick was going over risk of if you have a 3% bond and it goes to 6%, right? The bond value goes down. But there's a flip side to that too. Let's just say that you have a 6% bond, and we get into a recession, economy slows, inflation comes down, interest rates go down. All of a sudden, you have a 6% bond. New bonds are at 3. So if you sell your bond before maturity, you'll get a premium for it. You'll get more than what you bought it for.
Got it.
Okay.
So
it works both ways. Sometimes good, sometimes bad.
Got it. And then the second question that I had, Nick, I know you've been talking about, and again, we have the graph up on the screen, but I know you're talking a lot about the inverse relationship between interest rates and bond prices. Rates go up, prices go down, and vice versa. How are we measuring that? Are you just playing a game of, eeny, miny, mo? Are you predicting? Are you guessing? Is there some sort of mechanism out there that measures that type of risk?
Yeah, there is a tool, a measure that we use in the financial world to get a sense of the price change we could expect, like you said, with the seesaw. That term is called duration, and Ron has a good way of walking through that, so I'm going to let him go into it.
Sure. So duration, you can, it's published. If you're looking at buying an individual bond or a bond fund, you can find something called duration. And it's just measuring cash flows, really, the timing of cash flows. So specifically, if a bond fund has a duration of 20, say it's a long-term treasury bond fund, if rates go up 1%, that fund's likely to drop 20% in value.
Got it.
Okay, so if that happens over 1 year, where rates go up over 1 year, over that year, the fund may come down 20% in value.
I do have a question on that. Do you want me to add that in now? Or?
Sure.
So to me, so earlier we talked about treasuries being on the conservative end of the spectrum, very, very credit-worthy,
right.
Non-junk bonds. But then you're talking about a 20% decrease if rates go up 1%. To me, that sounds like pretty risky.
It does sound risky. So
is that contradicting what you said earlier?
From
Could
the
you just explain?
Yeah, sure. From the 1980s until right before COVID, we had an interest rate environment that was very level and actually had been going down. So during that whole period of time, these longer-term treasuries weren't very volatile. They tended to go up in value. It was only after COVID hit and then the recovery from COVID, when rates went up a lot, that those bond prices got hit. So interest rate levels tend to, the changes are very long lasting. It just tends to go in one direction for a long time and another direction for a long time. But it depends on the environment. Sometimes that longer duration can help, sometimes it can really hurt. Okay. Now, intermediate term bonds, maybe duration of 5. If rates go up 1%, they drop 5. Rates go down 1%, they increase in value by 5. So a lot less interest rate risk.
Got it.
That 20% example, that particular vehicle is not reflective, you would say, of like the typical bond investment duration that's out there.
No, but people use it.
Sure.
Yeah.
Now,
but no, most people would not have all their money in a long-term treasury fund.
So if you have a duration of 20, would you say that that's positively correlated or positively related to that, Nick, when you were first given the description at the beginning, where how you use the term principal and then at maturity you get the principal back? Would you say that the duration of 20 would be positively correlated with a long maturity, like 20 plus years till maturity, or is it not necessarily positively correlated?
Yeah, so typically the longer the period is before the maturity, the higher the duration, and the less you're compensated with interest along the way. So if you had a really low yielding bond that matures like 50 years in the future, you would have like a massively high duration. Like the duration would be almost 50, basically. Okay,
so it's positively correlated with maturity or when you're going to get that initial principal back.
I mean, it's in the name, duration,
sure.
Length, so that is a very good way of thinking.
Yeah.
About it.
I know now you're probably thinking to myself, what do I do? You have treasuries that are safe in one regard but not safe in the other, and then you have credit risk, and sometimes it's good and sometimes it's bad. Right. The white flag goes up.
Like how are you marrying all of that together to then craft a bond portfolio?
Right. Yeah, so I was going to say, Nick, if you want to explain, maybe like what A lot of people compare it to the aggregate index. And kind of give some background there, and I can maybe provide some statistics on top of that.
Yeah. So a lot of people, like in keeping with a lot of the investing culture these days, would just say, well, the way I'm going to deal with it is just buy the bond index fund, right? Very simple. It's very cheap. And that's based on an index that's called the aggregate bond index. And it basically is designed to capture all of the fixed income issuance in the U.S. And so it's like, yeah, just like with a stock index fund, I'll just own a little bit of everything and let the market kind of guide how it's invested from there. The market's efficient and the fund is cheap. We're good to go. We don't have an axe to grind with index investing really overall as a team.
Right, we use index funds.
We use index funds, but we don't use the aggregate index for our bond portfolio. And here's why. In a bond index fund like the aggregate, the holdings are literally just being weighted by who the largest issuers are. Mm-hmm. So if you're doing that with stocks and it's like, well, the most valuable companies by market capitalization are the biggest holdings in our index fund, okay, that's one thing. The market has kind of passed judgment on that. In the fixed income world, what you're really doing is just saying who are like who's putting the most debt out there.
Yeah.
And I'm going to buy the most of that.
You could have a company that's market value is not very high, but has a ton of debt out there, and you're buying more of it, which might not be the best thing to do.
And the last thing I want to say on that is when we talked about duration, when we talked about credit quality, all of these things, you're basically just saying, yeah, whatever that rolls up to when I own things in proportion to who is issuing the most of it, that's what I want my bond portfolio to look like.
Got it.
From just a common sense standpoint, it doesn't feel like the best way of doing it. So that's what we don't do. And that's what you are doing if you own a bond index fund.
Okay.
I will turn it over to Ron to talk about what we do and how it compares in terms of why we think it's a better approach.
What we do.
Yeah, what we do.
Yeah. I'll give you the stats and I'll explain why. So our bond portfolio, the yield somewhere around 6% right now, where the aggregate index.
Is that good or bad?
Well, it's relative. The aggregate index is 4.5%. So relative to the aggregate index, pretty darn good. Okay. So we have a yield advantage, but maybe it's because we're taking a lot of credit risk, but we'll get there. The second thing is duration risk, interest rate risk. The aggregate index is around 6. Our portfolio is probably 4, probably even a little less than 4. So what that means is that if the economy's strong, inflation's going up, interest rates are going up, we would take less of a hit.
Got it.
Okay. Now, what you could think is, okay, Ron, so you have more yield, less sensitivity to interest rates, but what happens if we get into a recession, right? So in a recession, economy slows, inflation comes down, interest rates come down. And in that environment, the duration plays a role and also credit risk. And so what happens is that our credit risk should be pretty similar to the aggregate index. In my view, it should be less sensitive, okay? And so we might have a little bit of leg up there. Also, the aggregate, and we're getting into the weeds a little bit here, but the aggregate has a lot of mortgage securities. And when rates go down, mortgage securities tend not to go up a lot in value because there's prepayment risk, okay? So what I'm getting at is during a recessionary time, I think that our portfolio can do basically as well, maybe even a little better. When rates go up, I think we'll do better. And if rates are flat, and in any environment, we're getting a better yield. So I think we have it set up very, very well.
So it sounds like...
Nick, I'm sorry.
No, I would just say at the highest possible level, what Ron described, the investment nerd term for what we do is a barbell. Think about like a barbell weight. And it's like stuff that you want to own to mitigate risk and stuff you want to own for yield and income. We balance those two against each other, and then your portfolio just does reps all the time.
I like that.
You guys are the Ronnie Colemans of bond investing.
That's what I do when I go to the gym.
I see, that is what he does. I've seen him.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724 888-271-7019 to get started.
So then it sounds like to me it's an art of balancing all of this out to craft a portfolio, because if you focus on one risk solely, then you're probably subjecting yourself to the other risk. So you have to decide, well, how much risk, how much credit risk am I comfortable taking to manage the duration risk? And then you find that kind of balancing point, and then you have a well-crafted portfolio.
And let me just get into a little bit of the secret sauce, okay?
The secret sauce.
Yeah, secret sauce. So about half of our portfolio...
We'll put the link to the secret sauce in the show notes.
Yes. So half of our bonds are adjustable rate, meaning when interest rates go up, what they pay you will go up. And so they should not have a lot of interest rate risk. The other half are treasuries that have fixed rates, so that when the economy slows, inflation slows, rates go down, they're protective during like a recession, okay? So that's pretty straightforward, but what we're also using is something called private credit. And so I mentioned 50% adjustable rate. Our private credit is about 30% of the whole portfolio. And so what private credit does is it's debt of non-publicly traded companies. The yield's very attractive, 10 to 11% right now. Very, very diversified. If you look at during the COVID crisis, its worst month was around a 2% drop, which compared to other things wasn't bad at all. So it sounds all great, but there's some negative. And the negative is that there is credit risk and there's less liquidity. And so what that means is you can buy it daily, but it's in the form of an interval fund. But interval funds tend to only give you quarterly redemption opportunities, and not all the time will you be able to get your money out, all of your money out, if there's some stress in the market.
Sure.
Okay, so liquidity is one of the primary risk of it. But the way we have it structured, since we have 70% in treasuries and about 30% in private credit, we're alleviating that credit or that liquidity risk because we have all treasuries, which are the most liquid securities in the world. So that's why our portfolio can have these unique characteristics, because we have this unique investment that we really build around.
Got it.
Nick, anything else to add to that?
No, I think I like when you're using these words like art and craftsmanship, like I that's how I like to think about it. I mean, there's some science behind the numbers, but it's also how you put all the pieces together.
The only thing that I this is what I guess everybody's thinking is, well, how do I get in touch with these guys, or how do I stay in touch with these guys? There's two ways. You can subscribe to the show if you use Spotify, Apple Music, or YouTube. We have a YouTube channel. You can subscribe to the show, or visit our website. You can sign up for our newsletter. We send out bi-weekly informative emails, or even click on the free Retire Wyze assessment. It's a 3-step process. We start by seeing if there's a good fit between what services or expertise you're looking for out of your team of advisors and what it is that we specialize in. Assuming there is, we actually get together a complimentary retirement plan for you, and we can certainly fold this conversation about bonds and risk into that conversation. But website's WYZE wealthadvisors.com. That's wisewealthadvisors.com. Feel free to check us out. Thanks.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.